I want you to pause what you are doing and truly listen to me right now, because what I am about to share could be the difference between your family keeping everything you built or watching it all get consumed by courts, lawyers, and the government. And I am not exaggerating. I am sharing the truth. That is what I do. You went ahead and did what most people believe is the responsible thing. You created a living trust. Maybe you hired a lawyer a few thousand to prepare it. Maybe you even felt good about yourself. You told yourself, I've taken care of it, my family is secured. And I understand that feeling, I truly do. But here is what nobody explained to you. And here is what concerns me deeply when I think about all the families who are going to discover this the hard way. Most living trusts are completely, totally, heartbreakingly useless. Not because the concept is flawed, but because people make critical, correctable mistakes that turn a powerful tool into a worthless piece of paper sitting in a drawer somewhere. And here is the part that truly hurts. The mistakes are not complicated. They are not obscure legal technicalities that only attorneys comprehend. They are basic, they are predictable, and they are occurring in millions of American households right now. So today I am going to guide you through exactly what goes wrong, exactly why it goes wrong, and exactly what you need to do to correct it. Because your family deserves better than to discover there was a problem after you are gone. Let's discuss what a living trust actually is and why people establish one in the first place. A living trust, or what attorneys call a revocable living trust, is a legal document you create while you are alive. You place your assets into it, your house, your bank accounts, your investments, and you designate someone, a trustee, to manage those assets for the benefit of the people you love after you are gone. The reason people select a living trust over a simple will is one word: probate. Probate is the legal process your estate goes through after you die if your assets are not properly structured to avoid it. And probate is costly. It can take months. In some states, it takes years. It is public, which means anyone can look up what you owned and who received it. And it is painful for families who are already grieving. A properly established living trust bypasses all of that. Your assets transfer directly to your loved ones. No court, no delays, no public record. That is the promise. But here is where the promise breaks down. The single most common reason living trusts fail, and I want you to understand me clearly on this, is that people never actually fund the trust. They create the trust. They sign all the paperwork. They pay the attorney, and then they do absolutely nothing else. They leave their house in their own name. They leave their bank accounts in their own name. They leave their investment accounts in their own name. And when they die, every single one of those assets has to go through probate anyway. The trust is sitting there technically valid, completely empty. It is like purchasing a brand new safe, placing it in your house, and never actually putting anything inside it. The safe does not protect money that is not in it. Funding your trust means legally transferring ownership of your assets into the trust. Your house needs to be retitled into the name of your trust. That means signing and recording a new deed. It is not automatic. It does not happen just because your attorney prepared the trust. It has to be done deliberately, specifically with each individual asset. Your bank accounts need to be retitled. You walk into your bank and you say, I need to change the title on this account to my living trust. Your brokerage accounts, same thing. You contact your financial institution. You provide them with a copy of your trust and you retitle the accounts. Now, I know what some of you are thinking. You are thinking, but I set up a trust years ago. My attorney handled everything, and I'm going to gently but firmly challenge that assumption. Go check right now. Pull out the deed to your house. Look at whose name is on it. If it says your name, your individual name, and not the name of your trust, your house is not in your trust, and your house will go through probate when you die. Period. Full stop. No exceptions. I have spoken to so many families who discovered this at the worst possible moment. A spouse passes away. The surviving partner goes to the attorney and says, "We have a living trust. Everything should be fine." And the attorney reviews the paperwork and has to deliver devastating news. The house was never retitled. The accounts were never changed. And now this grieving widow or widower has to go through months of legal proceedings, spend thousands of dollars in attorney fees and court costs, all while trying to hold their life together after losing the person they cherished most. That does not have to happen to your family, but you have to take action to prevent it. Let me share with you another mistake that catches people off guard. And this one is deceptive because it feels like you are doing the right thing. It's what occurs with beneficiary designations. Here's the thing about certain assets. They have their own built-in beneficiary system that operates completely independently from your trust and your will. Retirement accounts, your 401k, your IRA, your Roth IRA, these pass to whoever you designated as the beneficiary on the account itself. Life insurance policies function the same way. Payable on death bank accounts, transfer on death investment accounts, these all go directly to the named beneficiary. Regardless of what your trust says, regardless of what your will says, those documents are irrelevant. The beneficiary designation on the account controls everything. So what is the issue? The issue is that most people established those beneficiary designations years ago, sometimes decades ago, and they never reviewed them again. You named your ex-spouse as the beneficiary of your life insurance when you were 30 years old and then got divorced and completely forgot about it. You named your parents as beneficiaries on your retirement account when you were young and single. And now you have a spouse and children, and your parents have been gone for 20 years. You named one child and then had two more. The beneficiary designation does not automatically update when your life changes. It does not care that you got married or divorced or had children or remarried. It will send your money exactly where you directed it to go 20 years ago, no matter what you intended today. The remedy for this is simple, but requires your attention. Get every account in front of you, every retirement account, every life insurance policy, every bank account with a payable on death designation, and check who you have named. If it is not who you want it to be, update it today, not next week, not after the holidays, today. And then there is the question of whether to name your trust as the beneficiary or a person. This is where it gets nuanced, and I want you to grasp this, because getting it wrong can cost your family a significant amount of money in unnecessary taxes. For most non-retirement assets, your regular bank accounts, your investment accounts, your real estate, naming your trust as the beneficiary or titling those assets in the name of the trust makes good sense. That is how you ensure they flow according to your wishes without going through probate. But retirement accounts are a different matter. IRAs and 401ks have special tax rules. When you name a person as the beneficiary, especially a spouse, they get powerful options for how they receive that money. A surviving spouse can roll the inherited IRA into their own IRA, which provides them incredible flexibility and continued tax-deferred growth. Or they can take distributions over their own lifetime, which spreads out the tax obligation. These are options that only apply to individuals. When you name a trust as the beneficiary of a retirement account, you potentially eliminate those options or severely restrict them depending on how the trust is structured. This is a specialized area of law, and I am not going to pretend it is simple because it is not. But the core message is this: do not name your trust as the beneficiary of your retirement accounts without consulting an attorney who specifically understands the intersection of trust law and retirement account law. And make sure that attorney is drafting language that preserves as many options for your beneficiaries as possible. I also want to address something that nobody likes to discuss, and that is the fact that some trusts are drafted with genuine legal errors or outdated provisions that make them ineffective or even counterproductive. This occurs more than you think. Estate planning law evolves, tax laws evolve. What was optimal planning 5 years ago might be the wrong structure today. If you have a trust that was drafted more than 5 to 7 years ago and you have not had it reviewed by a qualified attorney, it needs to be reviewed. Not because something is necessarily wrong with it, but because you owe it to yourself and to your family to make sure it still functions, given the current legal landscape and given changes in your own life. Now, I want to shift direction because we have been discussing what goes wrong, and that is important. You have to understand the problems to correct them. But I also want to discuss the proactive steps you can take to make sure your trust performs what it is supposed to do and that your estate is structured as tax efficiently as possible, because a living trust by itself does not automatically reduce your tax liability. It avoids probate. But if you want to genuinely tax protect your final wishes, there are specific strategies that need to be incorporated. Let's discuss the estate tax. Now, I know that a lot of people hear estate tax and immediately think that does not apply to me. That is only for the extremely wealthy. And for most people, that has been true at the federal level. The federal estate tax exemption, meaning the amount you can pass to your heirs completely free of federal estate tax, has been very high in recent years. As of the time I am speaking to you, the exemption is substantial enough that the majority of Americans will not owe federal estate tax. But here is what you need to recognize. That exemption is subject to change by Congress. It has changed before, and it will change again. And in many states, there is a separate state-level estate tax with a much lower exemption. Some states have exemptions as low as $1 million. If you own a home that has appreciated significantly, have retirement savings, and have some life insurance, you might be closer to that threshold than you realize. So, what do? First, know where you stand. Get a rough estimate of your total estate value, your home, your retirement accounts, your investment accounts, your life insurance, death benefit, your business interest, any other property you own. Add it all up. This is your gross estate. Then compare that number to the current exemption in your state and at the federal level. If you are nowhere close, you can breathe easier. If you are in the range where estate taxes could become a concern, that is when you need to have a serious conversation with an estate planning attorney and a CPA who work together. One of the most powerful and underutilized strategies for reducing potential estate taxes is gifting. The IRS allows you to give a certain amount to any individual each year completely free of gift tax and without it counting against your lifetime exemption. This annual gift tax exclusion has been in the range of $17,000 to $19,000 per person per year, and it applies to each recipient. So if you have 2 children and 3 grandchildren, you and your spouse can each make annual gifts to all 5 of them, which adds up to a meaningful amount of money, leaving your taxable estate every single year completely tax-free, compounded over many years. This strategy alone can substantially reduce a potential estate tax obligation. But let me be very clear about something. Gifting strategies need to be thoughtful. You should never give away money that you might need. Your financial security in your own lifetime is not negotiable. I do not care how much you love your children or your grandchildren. You do not impoverish yourself for the benefit of the next generation. You must be financially secure yourself before you start considering wealth transfer strategies. This is not selfishness. This is prudence. A parent who gives away too much and then runs out of money becomes a financial burden on their children, which defeats the entire purpose. Now let's discuss something that affects almost every family and yet is almost universally mishandled: the step-up in cost basis. This is one of the most valuable tax benefits in the entire tax code, and most people have never learned of it. Here is how it works. When you own an asset, let's say a stock or a piece of real estate, and it grows in value over the years, that growth is eventually going to be subject to capital gains tax when someone sells it. The original purchase price is called the cost basis. The gain is the difference between what you paid and what you sell it for. Capital gains taxes can be substantial, especially on assets that have grown a lot over a long period. But here is the benefit that happens at death. When you pass an asset to your heirs through your estate, whether through a trust or any other means, the cost basis of that asset gets reset to the fair market value at the time of your death. This is called a step up in basis. What this means practically is that if your heirs then sell that asset immediately after inheriting it, they owe zero capital gains tax, regardless of how much it grew while you owned it. Let me give you a specific example so this registers. Suppose you bought stock 30 years ago for $10,000. Today, that stock is worth $300,000. If you sell it while you are alive, you owe capital gains tax on $290,000 of gain. At the long-term capital gains rate, for many people, that is going to be somewhere between $40,000 and $70,000 in taxes. But if you hold that stock until you pass away and it goes to your heirs through your estate, the basis steps up to $300,000. They inherit it at $300,000. They sell it for $300,000. They owe zero in capital gains taxes. Zero. That is potentially $60,000 or $70,000 that stays in your family instead of going to the government. This is not a loophole. This is not tax evasion. This is how the tax code was designed, and it is there for you to utilize. The implication of this is critically important for how you think about gifting strategies. If you give appreciated assets to your heirs while you are alive as a gift, they receive your original cost basis. They do not get the step up. So, if you gift that stock to your child while you are alive and then they sell it, they owe capital gains tax on the full $290,000 gain. On the other hand, if you hold it until you die and it passes through your estate, that tax disappears entirely. This is why in many cases it makes more sense to gift cash, which has no embedded gain during your lifetime, and hold on to your appreciated assets to let the step-up accomplish its purpose. This is exactly the kind of planning decision that requires both an estate planning attorney and a tax advisor working together, looking at your specific situation, understanding which of your assets have the most embedded gain, and helping you decide what to hold, what to gift, and when. Let's discuss life insurance because it is one of the most misunderstood components of the estate planning puzzle. Here is something that surprises a lot of people. When you own a life insurance policy, when the policy is in your name, the death benefit is included in your taxable estate. So, if you have a $2 million life insurance policy and the rest of your estate is worth $1 million, your taxable estate is $3 million, not $1 million. For people in states with lower estate tax exemptions, this can create a tax bill that your family was not anticipating. There is a solution to this, and it is called an irrevocable life insurance trust, often referred to as an ILIT. When an ILIT owns the life insurance policy instead of you, the death benefit is not included in your taxable estate. It still goes to your beneficiaries. It is still distributed free of income tax, but it does not inflate your taxable estate. This is a strategy that requires working with a qualified estate planning attorney because, as the name indicates, an irrevocable trust generally cannot be modified once it is established. You need to get it right from the beginning. But for families who have significant life insurance and who are concerned about estate taxes, an ILIT can be a powerful instrument. And speaking of irrevocable trusts, let me add a word about the difference between revocable and irrevocable trusts, because this distinction matters enormously for tax purposes. A revocable living trust, which is the standard trust that most people establish, is completely flexible. You can change it, you can revoke it, you can take assets back out. You are in control. That flexibility is wonderful for managing your estate while you are alive, and it does the job of avoiding probate when you die. But because you have full control over the trust, the IRS treats it as if you still own everything in it. All the assets in your revocable trust are still part of your taxable estate. A revocable trust does not reduce estate taxes. Let me repeat that again because it is important. A standard revocable living trust does not reduce your estate taxes. It avoids probate. That is its primary function. You generally cannot retrieve them back. But because you no longer control them, they are no longer part of your taxable estate. That is the trade-off. You give up control in exchange for removing those assets from estate taxation. There are many types of irrevocable trusts: GRATs, QPRTs, charitable trusts, special needs trusts, each designed for specific situations and goals. These are not DIY documents. These are complex legal instruments that need to be drafted by specialists and reviewed by your tax advisor. But I do not want the complexity of irrevocable trusts to overwhelm you or make you feel like estate planning is only for the extremely rich. It is not. The most important steps: funding your revocable trust, updating your beneficiary designations, reviewing your documents regularly, and being intentional about what assets you hold and what you transfer. These are accessible to everyone, and they make an enormous difference. What happens to your email accounts, your social media accounts, your online banking, your cryptocurrency, your digital photos? Most people have thousands of dollars worth of digital assets and no plan for what happens to them. Some states have enacted laws addressing this, most have not. Your trust documents need to specifically address your digital assets. You need to maintain a secure record of your usernames, passwords, and account information kept safely, not in the trust document itself, since that becomes a public record in some contexts, but in a secure place that your trustee knows how to access. This is not complicated, but it requires intentionality that most people have not applied to this area of their lives. And let me mention something about choosing the right trustee, because this decision is more important than most people realize. Your trustee is the person who is going to be responsible for carrying out your wishes. They are going to be the one who communicates with banks and attorneys and beneficiaries. They are going to be the one making decisions about timing, about distribution, about investments. This is a real responsibility. Choosing the wrong trustee can undermine even the most perfectly drafted trust. A lot of people name a family member, and that can work well if the family member is organized, financially capable, and able to remain fair in the face of potential family conflict. But I want you to consider carefully whether your chosen trustee actually has the time, the skill, and the temperament for this role. Sometimes the most caring thing you can do for your family is to name a professional trustee, a bank's trust department, or a trust company, rather than putting that burden on a child or a sibling who is also going to be grieving and who may not have the financial knowledge to manage the responsibilities effectively. You can always name a family member as a co-trustee to ensure that personal touch and family oversight, while having the professional bring expertise and accountability. The reason most people do not update their estate documents, the reason they do not fund their trust properly, the reason they never review their beneficiary designations, it is not ignorance. Most people know they should do these things. It is avoidance. It is the deeply human tendency to not want to think about our own mortality. And I understand it, I appreciate it, but here is the truth that I want you to reflect on. Every single day that you delay this is a day that you are leaving your family exposed. You are a thoughtful person. I can tell that because you are here, you are listening, you care. So let that love be the motivator that overcomes the hesitation. Do this for the people who matter to you. Take out a piece of paper right now or open a note on your phone. Write down these action items. First, locate your trust documents and verify that your assets are actually titled in the name of the trust. If you are not sure, call the attorney who drafted it or call your financial institutions directly. Second, pull up every financial account, every bank account, every retirement account, every brokerage account, every life insurance policy, and check the beneficiary designations. Write them down. Confirm that every single one reflects your current wishes and your current life circumstances. Third, calculate a rough estimate of your total estate, everything you own, including the death benefit of your life insurance. Compare that to the estate tax exemptions in your state. Fourth, make an appointment with an estate planning attorney, not next month, this week. Call and schedule the appointment. Fifth, if your trust is more than 5 to 7 years old, ask the attorney to review it for accuracy, for current law compliance, and for any opportunities you may be overlooking. These are not enormous leaps. These are small steps. Each one is manageable. Each one moves you closer to the peace of mind that comes from knowing your family is protected. There are attorneys out there who will charge you significant fees to draft a trust and then send you home without properly explaining how to fund it. There are advisors who will sell you complex financial products wrapped in estate planning language without explaining whether those products actually serve your goals. You deserve better than that. You have the right to ask questions. You have the right to demand that things be explained to you in plain language. If an advisor cannot explain their recommendation clearly and simply, that is a concern. It is your money, your legacy, your family. You are the one who has to live with the outcomes. So ask questions, push back, demand clarity. Never sign anything you do not understand. And if you have children with special needs, if you have a blended family, if you have a child who struggles with financial management, if you have a family member who depends on government benefits that could be jeopardized by an inheritance, please know that there are specific trust structures designed for exactly those situations. A special needs trust can protect a beneficiary's eligibility for government assistance programs while still providing for their care. A spendthrift trust can protect assets from a beneficiary who might otherwise deplete their inheritance. These situations require specialized legal expertise, but they are absolutely solvable. Do not let complexity be an excuse for inaction. A living trust is one of the most powerful tools available to protect your family from the cost, delay, and heartbreak of probate. But a living trust only works if it is funded. An unfunded trust is worthless. Go verify that your assets are actually in your trust. A living trust by itself does not reduce estate taxes. It avoids probate. If your estate is large enough that estate taxes are a concern and the threshold might be lower than you think, especially at the state level, you need to consult professionals about additional strategies. Your beneficiary designations override everything else. They override your trust. They override your will. They are the most powerful document in your estate plan, and they need to be current. The step up in cost basis is one of the greatest tax advantages available to your family. Understand it. Leverage it. Do not accidentally give away appreciated assets when holding them could save your heirs a fortune in capital gains taxes.